Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, I speak with Sebastian Lyon, founder and chief investment officer of Troy Asset Management. Troy managed the Personal Assets Trust, one of the UK's most popular capital preservation trusts. They took it over in 2009. Since then, the trust is up 204%. The UK Retail Price Index over the same period is up 85%. So you have very comfortably beaten inflation since then. You've also beaten inflation comfortably over 10 years. Now, the last year has been much better for personal assets. If you've been holding shares in the trust, you're up 9.3% when the UK Retail Price Index is up only 3.7%. So we talked to Sebastian now to find out what next. We discussed the investment trust industry as well. We discussed American exceptionalism and why there are good reasons to be cautious. And also, of course, crucially, his outlook for gold. Sebastian, thank you so much for joining us today. It is a huge pleasure to have you on.
Pleasure, Merryn.
Right, now we've got an awful lot to talk about, so let's start rattling through this. The first thing I want to talk about with you, because you are such an expert on the investment trust industry and our audience is very interested in this. The investment trust sector as a whole has found itself in a bit of a pickle, as exemplified by the whole Saba saga. Anyone, by the way, who doesn't know about the Saba saga, the activist attack on the sector, please go back and listen to some of the many, many podcasts we've done on this, and in particular, John's interview with Boas Weinstein, the CIO of Saba, who talks a lot about what he's trying to do and why approve or don't approve. I suspect Sebastian doesn't approve, but we'll get to that. So a little history, Sebastian. How did we find ourselves in the pickle that we're in?
Yeah, Saba has disrupted the sector, Merryn, and some good trusts and some trusts have been punished for effectively poor liquidity and not defending discounts. And effectively this started, we have to go back to your favorite time in history, the financial crisis.
Oh, love that.
Because in 2009, interest rates were cut to zero and stayed there. Effectively, what people realized, it took a few years for the penny to drop, probably until about 2012 or 2013. When central banks started introducing forward guidance, takes you right the way back to that, effectively forward guidance was when central banks said, we're not going to raise rates for a long period of time, 2 years, 3 years, 4 years. And so suddenly everybody realized that interest rates weren't going to go back to where they'd come. And that effectively bond yields fell very sharply, went down to, low single digit percentages. And everybody was desperately looking around who needed income for income. And so there was a huge amount of issuance from investment trusts, alternatives and equities from 2013 for a decade. So from the decade up until 2022, there was £25 billion of issuance. Mainly, that's primary issuance. That's either investment trusts issuing new shares to the existing investment trusts, issuing new shares to their shareholders, to new shareholders, or it was actually IPOs, so new investment trusts launching.
Sebastian, sorry, I'm going to interrupt you briefly. Just to ask you to explain to listeners who aren't completely au fait with the sector, why, if you need income, do you see new investment trust issuance?
Because effectively, these investment trusts were offering a higher yield. So they were offering that 4 to 5% yield, which everybody was looking around for in a zero interest rate environment. In many ways, they were investing in high yield equities. They were investing in alternatives like infrastructure, those sort of areas where there is on balance, a high yield. Also private credit, various ways. And the other thing is that they were just looking for alternatives. They were looking for alternative assets which were going to generate a return because they weren't having a return from cash. That was the key difference. And the problem is that the primary issuances are very easy to get in. It's not quite so easy to get out, as we've discovered. So the secondary market, i.e. this is the buying and selling of the investment trust shares, is a lot more tight and it's a lot less easy than the primary market, i.e. if you want to buy new shares.
Yeah.
And effectively, we had record issuance for a decade. And then what happened? What happened in 2022? Inflation went up. Interest rates went up to 5%, and suddenly shareholders didn't need that yield any longer because they could get it from gilts or they could get it from cash in the bank. And there wasn't any liquidity within the investment trust sector to effectively allow investors to move their money and effectively liquidate those shareholdings that they'd made during that zero interest rate environment. So suddenly we've gone from a period of lack of liquidity. And really the reason why Saba was able to buy the shares that he bought in 2023 and 2024 was because there were no buyers. There were no buyers and plenty of sellers. And the problem was that the boards and the managers didn't buy back enough stock, so the discounts just widened, and that allowed Saba to come in and buy the stakes that he did. And I think that coming to Saba, I think that obviously, as you within your podcast with John have reported on, the votes of the 7 trusts which he was attacking effectively were won convincingly. That's the first sort of battle won by the trust sector. But he's not going away. No. He's got these huge stakes of 25, 30%, and he'll probably find others to invest and perhaps vote along with him. But I'm actually optimistic about the trust sector. And this might sound a bit strange talking as we are today with the trust sector having been under threat. Yeah. But investment trusts got a 150-year history. The one thing they have managed to do is adapt. I think we will see over the next 5 years a very material change. We will see huge mergers. We'll need to see improved liquidity. That is the key. That is the thing that's been missing. And that is the thing that the trust sector needs to rediscover. And there needs to be a concerted effort on the part of boards and on the part of the managers as well to put shareholders first, to reduce those discounts. So how do we do that?
I'm going to interrupt again.
Yeah,
Sorry,
sure.
Sebastian.
Yeah.
I take all that you're saying,
yeah.
but the answer from much of the industry to that is, well, hang on a tick. One of the spectacular things about the investment trust industry, and one of the things that many think has driven the very long-term outperformance of the industry, is the idea that the capital inside each trust is permanent. So you don't have to constantly, as a manager, buy and sell the assets in your portfolio to meet changing demand for the shares. You just get to focus on running the money, and that's it. Now, if you move into an environment where you constantly have to issue buyback, you take away that advantage, and perhaps the whole thing becomes pointless. You might as well just get an open-ended fund.
I'm not sure about that. I think the world has changed. I think that's frankly a bit of a naive view. I'm not sure that permanent capital really exists anymore. The evidence is beginning to stack up that that's not necessarily the modus operandi. Now, there are some parts of the illiquid market, particularly in alternatives, renewables, that sort of thing, where there is a liquidity, private equity, and that has to be permanent capital because that's the nature of the beast. And they will probably have to offer liquidity on an annual basis or on a 3-year basis or whatever it might be. But I think the whole idea of absolutely permanent capital forever, I think that the sector is going to struggle with that argument.
But if you don't have permanent capital, you just have a listed vehicle, which the manager has to buy and sell, and really it's just an active ETF.
Well, I think that the stock market doesn't need active ETFs because they've got investment trusts.
Well, wouldn't active ETFs be cheaper?
They might be marginally cheaper, not necessarily. Not necessarily. I don't think so, not necessarily. I mean, an active manager has an active fee. So, I mean, it wouldn't necessarily, it might be marginally cheaper. I think the future of trust, certainly equity investment trust could be an active ETF. And I don't think necessarily you need an active ETF if you've got investment trusts that are liquid and large and that are easily traded. Active ETFs in the US have boomed, but they boom for a particular reason, which is actually quite a niche reason, which is tax. Mutual funds are less attractive from a tax point of view than active ETFs. That's why the active ETF market has grown. I don't think necessarily we need a big active ETF market in the UK because the tax benefits are different in the UK. You get all the tax benefits by investing in an investment trust that you would in an active ETF. There's no difference. There is this view out there that we need, active ETFs are the new product. We need this. Actually, the way that investment trusts can adapt and ultimately grow in the long run is perhaps to challenge the active ETF idea and actually be an active ETF themselves.
Okay, well, let's go back to how you think discounts should be controlled then, so that we get to this point where we're effectively an active ETF without being an active ETF.
So, Merryn, as you well know, for the last 15 years since I became investment advisor and latterly investment manager at Personal Assets Trust, I've been howling into the void, telling the investment trust sector and investment trust boards and managers that liquid portfolios, equity portfolios, multi-asset portfolios, etc., should put in place a discount control mechanism. Personal Assets has had a discount control mechanism in place for 25 years. It has never traded at a discount of more than 2%. So it can be done. And by the way, if you're not trading at a wide discount, SABA isn't interested. Arbitrageurs do not come on your shareholder register if you haven't got a discount. So it is a way of keeping the arbitrageurs at bay. And how you do this is you issue if you move to a premium of more than 2%, and you buy back if you go to a discount of more than 2%. And that is how you do it on a day-to-day or weekly basis. And there are days when you buy back your stock if the discount goes beyond 1.5%, 2%. And if the shares trade at a premium, you can actually issue and grow the trust. And we succeeded in growing Personal Assets for many years. Actually, in this more recent period, we have been shrinking. That's fine. And the board and the manager, myself, are very happy with the idea of the trust shrinking over a period. We bought back about £200 million worth of stock in the last 2.5 years, since March 2023.
Yeah.
And we actually issued shares a week ago. So we're not just buying back, we are also issuing as well.
Yeah. I suppose the answer to that, again, would be it's all right for you, Sebastian. Personal Assets is a massive trust, couple of billion. It doesn't matter if you shrink a little. But there are a lot of trusts out there in the market that are knocking around 200 million, 300 million, some even less. If demand for their shares isn't out there, i.e. they're in the wrong asset at the wrong time, even though, maybe let's talk about perhaps, Japan trusts before Japan started performing again. These weren't things that anyone was going to go to for a while. But when the market starts moving again, they're incredibly valuable vehicles to have out there, right? But if they were to buy back and buy back and buy back and buy back, they're going to disappear. And certainly the wealth managers aren't going to buy them because they're just too small. So if you start down that road, you're going to lose an awful lot of the investment trust market.
I think there are too many trusts, and I think there does need to be consolidation. And there has been consolidation, Merryn. You've seen, I think there were 9 mergers last year. And I think that is what we need. We need to see some larger trusts. I go out and I see wealth managers very regularly. The one thing they say to us is, we need more liquidity within the investment trust sector.
Yeah.
So that is the future. That we probably got. I don't know how many Japanese trusts there are out there, but there probably needs to be 2 or 3, not 10, or whatever the number is. And they need to be of greater scale. They need to be £500 million plus. We have another trust at Troy, the STS Global Income Trust, which we do have a DCM. We issued stock a few years ago. We have been buying back, but we have a hard DCM there. So it can be done even on a £300 million trust. I think that is the way to do it. If we didn't have the DCM on STS Global Income, then probably the shares would have gone out to a discount and an arbitrageur would have come on the board. The problem is the board would be focusing on the arbitrageur and the arbitrageur's needs and not the wider shareholder base. This is the problem with SABA, is it actually becomes a distraction, becomes a huge distraction to the board and to the manager, and it's avoidable.
Okay, DCM, by the way, anyone listening, discount control mechanism. I'm not sure if we said that earlier, just so you know. Right, so the message there, Sebastian, the message you have for the rest of the sector is be more like you.
Well, be more like us. I mean, there are others who have done this. There are 4 or 5 trusts out there who've put in hard DCMs over the last 5 or 10 years. We're not the only ones at all. But I think if you want to solve this problem, I think that is the future. And certainly I think there is this demand for larger trusts, more liquid trusts. Investors want certainty. The one thing that they don't want is to be able to think, oh my goodness, if I buy this trust, is it going to go out to a 20% discount over the next year? They want certainty and they want liquidity. And the trust sector needs to offer that.
Okay, last question on this. What happens to the very illiquid renewables trusts, the alternative renewables, the private equity, all these things that are trading at whopping great discounts? That liquidity is not coming back because the underlying assets are not liquid. You can't just say, oh, well, no one really fancies this trust anymore and there's not much demand around, so I'll pass on some of those private equity assets that I've grotesquely overvalued and nobody wants.
Look, there is a huge oversupply in alternatives. I mean, 75% of that issuance from 2022, that 25 billion, was in alts. They're illiquid, as you say. And the question is how realizable are those assets? And particularly, are those discounts real discounts or how strong is the NAV? And that's debatable. I don't know the answer to that question. But I think the answer to your question in terms of what happens to those is that, and we've seen this with KKR bidding for one, that will be the solution. Effectively, there will need to be consolidation in that area, and they will ultimately, over a period of time, and it will take time because of the nature of the assets, have to return the cash to shareholders. But that's a much longer game.
Okay, well, let's put all that to the side. Let's go on to the environment as a whole. Now, your setup, or the idea of personal assets trust and Troy in general, is to protect capital in every environment, right?
Yeah.
Just give me an overview of where you see the macro environment right now. What's changed? Where are we? And we're seeing at the moment, John and I have been talking about this momentum shift in markets away from the US towards Europe, etc.
Yeah.
Obviously, there's lots of confusion around where inflation is, where economies are going, etc. What does it look like to you in the round?
There's one thing that's been consistent, and there's one particular thing I think that's changed, and it's actually changed in the last really month or two. So the thing that's been consistent, and we've been consistent on, and when I last spoke to you 2 years ago, I don't think has changed, is that we are in a rising yield environment. I think everything changed during COVID. During COVID, we ended a 40-year bull market in bonds. Bond yields bottomed. US Treasuries and gilts yielded about 0.5% 10-year gilts back in the summer of 2020. Ever since then, yields have been rising. And the reason for that is that we move from an environment of purely monetary stimulus, i.e. zero interest rates and QE, to a world of fiscal, where governments began spending money on furloughs and on defense as well. And what we've seen within that environment, and to some extent Ukraine and the invasion of Ukraine assisted with this, but nevertheless it was probably going to happen anyway, is that inflation rose and then has become stickier. And as a result, rates have remained higher than people have expected. So there was an expectation that with inflation spiking, as it did in 2022 and 2023, that it would come clattering back down, and then everything would return to normal and interest rates would go back down. And
transient.
Transient, exactly. And transient hasn't happened. And inflation has remained stickier. We saw, Merryn, the January RPI numbers, 3%, which were above expectations. We saw them in the US, again, 3% above expectations. And they're actually talking about inflation being well above target for this year. So effectively, whereas in the last decade, in the 2010s, inflation was below target and central banks found it hard to get it up to that 2% target, this decade, actually, the opposite is the case. Inflation, we've struggled to get it down to target, and it's remained stickier than expected. And that means that probably interest rates are likely to remain higher as well, or rise rather than fall. Now, what that means for markets is that whereas in the past, bonds and equities, cheek by jowl, have been a wonderful investment, they've sort of been a self-hedge for one another. When growth accelerated, equities did well. When growth decelerated, bonds did well. That hasn't worked, and clearly didn't work at all in 2022. It was very, very painful for balanced funds that had both bonds and equities. And so we have been more cautious about that concept, and we've owned a mixture of assets. Particularly, we've owned index-linked and shorter-dated TIPS, the Treasury inflation-protected securities, so US index-linked, if you like. They have done much better over the last 5 years than conventional bonds, because you've got that inflation coming through, and there are real yields of around 2%. So you get 2% plus whatever inflation is. So they're up about 25% in the last 5 years, whereas fixed income's up only about 5%. But in the knowledge that inflation's likely to be stickier and likely to hang around for longer, we have been considering inflation as the issue, and clearly that's not great for fixed income. It's not great for bonds. So we've been cautious about bonds, and particularly taking duration risk, i.e. investing in longer bonds. But the thing, coming back to the thing that's changed in the last couple of months, is that I think that, Merryn, we're in the reverse of what's happened since 1989.
Yeah.
I started my career in October 1989. I know you were still at school back then.
I was, definitely.
But in November 1989, a month after I started my career, the Berlin Wall came down. And ever since then, we've been in a sort of guns into plowshares, disinflationary environment. And that is now very clearly reversing with a Labour Prime Minister standing up and talking about big additions to defence spending. So I think in that respect, the world has also changed. And that means that is also incrementally inflationary. That will be defense spending means, I'm afraid, means higher inflation. You look back in history, wars are inflationary and defense spending is inflationary. So again, that adds to that uncertainty and also adds to those inflationary pressures. Now, finally, you talked about markets and about the change in US leadership. And one of the things that was discussed a lot last year and the year before, really, but particularly last year, was this concept of American exceptionalism.
Yeah.
I.e., everybody was pouring money into the US and no one was investing anywhere else. We've been investing just a little bit less in the US and a little bit more in the UK and Europe more recently. I think that the problem with American exceptionalism, there's no doubt that, one only has to look at the numbers, one only has to look at the companies. And I see this, I hear fund managers talk about this, and there's a very cogent and coherent argument, but it's now well known. It's in the price. And I think that when you hear the words exceptionalism about a market, alarm bells should ring. I think there are good reasons to be cautious and good reasons to perhaps diversify. Whereas where we've been adding is particularly in Europe. So where valuations are now very, very low.
Yes.
So and in good companies as well. One of the things that I always push back on when people say, well, why aren't you buying in Europe? Is actually the good companies, well-diversified businesses that have good long-term track records, good returns on capital. They were always actually there was a rarity value within Europe, and they were actually quite highly valued compared to their sometimes compared to their US peers. I mean, I think of things like LVMH and L'Oreal and Heineken, etc. And actually they're not anymore. That relationship has broken down, and there are some attractive opportunities now in Europe.
If I look at your top holdings, they don't budge much, do they? We'll come back to gold, but gold is pretty much always your top holding, and you hold it in.
Yeah. Well, gold is not an equity; it's part of diversification.
Yeah, we'll come back to that in a minute. But the names at the top: Unilever, Microsoft, Diageo, Alphabet, Visa, Nestle, Heineken. I've seen all these at the top of your list for years.
Well, Heineken's only been there for the last 18 months.
All right, not Heineken then, but the others.
Well, they do move around.
Yeah.
But the top holdings don't move around a huge amount because actually we like to have low turnover. That is the way that we've always done it. But we like to selectively buy stocks from time to time as they become available at very good prices. And Heineken is a wonderful, coming back to your European argument, Heineken is a wonderful opportunity where we like to buy companies that have been out of favor for a long time. And Heineken is a good example of that. For the last decade, it's gone nowhere. The share price, the valuation is the lowest it's been in over a decade. So that is where we have been allocating capital. It's those sorts of places.
And when you say valuation is the lowest it's been for a decade,
we were buying it in January at 13 times earnings. So it's pretty attractive, we think, from that level. And now it might not go. It actually had reasonable numbers, and the share price has bounced for the year to date. But one swallow doesn't make a summer. So we will wait and see what happens. We think from that sort of valuation, the downside risk is actually pretty minimal. And the market just isn't interested. I mean, when we've made good equity selection, to your point about the portfolio, when we made good equity selections for, I think about Unilever, we bought back in 2004. In Microsoft, we bought in 2010. These were all wonderful opportunities to buy these stocks when people were bored of them and they were out of favor. They're not bad businesses, but the market, for whatever reason, had lost interest. And that's when things are interesting for us.
Is there anything else you've bought over the last year?
Rather embarrassingly, it has been a US stock, although it's a very good example of markets ignoring a business which is strong and robust and continues to deliver, but just they lost interest. And that's a company called VeriSign, which owns the .com and .net domain names based in Virginia. And it got hugely popular during COVID. The share price went up and the multiple went up to 40 times earnings. It was one we were watching. And then last summer, the multiple fell, the valuation fell to less than 20 times earnings. This is a stock actually which Berkshire Hathaway owns a holding in. We bought back last summer a meaningful, that's in our top 10. And subsequent to that, the shares have done pretty well. And actually, Warren Buffett's been following us in, which has been rather flattering. I think it actually shows, Merryn, that there is a dichotomy within, or divergence between, in the US market as well. There's clearly a very big dominance of the large platform companies, the Apples of this world, which are on 35 times earnings, that are multi-trillion-dollar companies, which are effectively driving the index returns. But actually, scrape below the surface, look at the unweighted index, and there are companies like VeriSign out there that are good businesses that are actually not as exceptionally priced as some of the larger companies.
Is there anything you've sold out of the portfolio recently?
Reduced a couple of holdings. So we reduced our holding in Amex, which has been an exceptional performer, which we've held for over a decade. And we've also reduced our holding in Procter & Gamble, which similarly, conversely to Unilever, has done very well over the last decade, thanks to Nelson Peltz coming in. So what Nelson Peltz has done for Procter & Gamble, perhaps he can do for Unilever. We will see. But we're actually rather optimistic about that. And the other holding that we sold last year was Becton Dickinson, which is the world's largest syringe manufacturer and medical devices business, which we also sold. That's another US stock.
Okay. Well, as you know, what I really want to talk about is gold.
Of course. You've taken a long time to get
I'm just
there.
waiting. I know. I've been holding myself back, obviously. As long as I've known you, it's been the largest holding in the trust. It's knocked around between 9 and 12% pretty much all the time.
It's
right?
around
I remember it being
it's
lower
been a bit
than
higher
that.
and a bit lower. Yes.
Yeah.
Correct.
So tell us why. In particular, tell us why you hold it in the form of actual bars.
Yeah, and why not miners or etc. We have held miners in the past. We've held 3 miners and 1 royalty and streaming business in the portfolio. I'm pleased to say that we've made money in a few of them and lost money in one of them. We don't currently hold any miners. And the reason for that is that it's actually much harder to make money in gold mining than you think, even if the gold price is rising. By way of an example, we used to have a holding in Franco-Nevada, which was a streaming and royalty business. We pretty much doubled our money in it, but we sold out of it in 2023 because it's the largest stream that it had was in Panama, and the Panamanian government, and we saw this coming, fortunately, so we sold before this happened, but we could see the writing on the wall. The Panama government decided to shut the mine, and that led to Franco-Nevada's revenues effectively falling by almost a quarter, because if that mine wasn't producing gold, then they weren't receiving their stream. It's a very messy business, gold mining. Actually, as you say, the gold mining sector has been really dismal. I mean, just on Franco-Nevada, I mean, the share price is around the price that we sold it 2 years ago. The gold price is up, I think, 30%, maybe a bit more, maybe 35, 40% since we sold Franco-Nevada. Now, all things being equal, Franco-Nevada's share price should be up 50, 60% with the gearing to the gold price. Its fixed costs are actually very low because it employs very few people. So it's very operationally geared to the gold price. And yet the share price is exactly the same as it was when we sold it. So we have been right to own bullion instead of own miners, I'm afraid.
Okay, so let's put gold miners to one side for the moment and let's talk about gold itself. The bullion that you hold, the price of gold is going up. What do you think is going on in the gold market? I mean, maybe you think it's just because they're about to go and revalue everything in Fort Knox, but I suspect you've got something more nuanced to tell us.
Actually, interestingly, that hasn't really, all of that news about Fort Knox and going to have an audit hasn't actually moved the price particularly. So I think that's probably noise. I think that what has happened in the last 3 years, we've seen the gold price, and last year it was up 30%. Something has changed, and I think the material change has been the marginal buyer. And the marginal buyer has been not private individuals, not institutions. It's actually been central banks. It's been Poland, Singapore, Czech Republic, Turkey, China, India. They've all been buying. Now, why have they been buying? I think it's all to do with de-dollarization, and it's all to do with the fact when did they start buying? They started buying very materially in the third quarter of 2022, and they've been buying consistently since then. What happened in 2022 was the invasion of Ukraine and the confiscation of Russian assets, $320 billion, most of which was held in Europe, was effectively frozen. And that has led to governments around the world thinking, do we really want all our reserve assets in dollars, which they've been growing for the last 50 years in dollars as the ultimate reserve currency? And we've heard Scott Besson talk about this in terms of gold being the reserve asset. And effectively what these central banks have been doing is they've just been diversifying. Now, when they look at their portfolio, and their portfolio is full of US dollar debt and other foreign currencies, but predominantly US dollars, what else are they going to buy? Are they going to buy sterling? Well, I mean, sterling was the reserve currency 100 years ago. They're not going to go back into sterling or go into euros, which remains still somewhat of an unproven currency. And they're not going to go into very small currencies like the Swiss franc or the Norwegian kroner. So they've got less choice, and they're probably returning to the ultimate reserve asset, the ultimate reserve currency, which is gold. And so that is where the demand has come from. And I think that the fact that private investors and institutions haven't been buying means that this isn't some sort of rabid bull market, a hugely speculative bull market. We're not there yet. We have trimmed our holding in the last year, because otherwise, if we hadn't done that, shock horror, but if we hadn't done that, our holding would be up sort of 16%. And as somebody who's mindful of value, that one wants to decrease one's holding, wants to manage one's risk when an asset like that rises as much as it has done. We want to do it in the stock in the same way that you want to do it in another asset.
But presumably you are expecting that central bank demand to continue for a while, and you'd also expect in an environment like this with a sharply rising price for retail investors to start to come back in. I mean, we all chase a rising price, right?
Correct.
So it would be reasonable to expect gold to do relatively well over the next few years.
It would be reasonable to expect that, yes. And the other, coming back to the earlier question about, do you expect central banks to continue to buy? Yes, I would, because if one looks back in the past, when they start buying, they tend to buy for very long periods of time. They didn't buy for a quarter or two and then stop. They buy for years and years. That is unlikely to suddenly stop. And with all the talk of geopolitics that's going on and increased defense spending, etc., I don't think that the reasons for them to actually start buying are not likely to reverse anytime soon.
Well, I know, Sebastian, that you're also a secret, very enthusiastic crypto buyer, right? No. No. Okay, so there's no.
So I'm too old. I'm too old for it.
Are you? Why would you be too old for it? I mean, if you thought it was a fabulous investment, you would buy it, regardless of your age.
True, but I don't understand it. It's been explained to me many, many, many times. And I prefer the concept of an asset that's been around for 6,000 years and has been a store of value for 6,000 years, rather than one that's been a store of value, also a supposed store of value for the last 15. And as we saw, Merryn, we saw a $1.5 billion hack of a platform of crypto. So it's not necessarily as safe.
Well, I suppose the thing is that if you hold it on a platform, it's no safer than anything else you hold on a platform. As soon as you go for the middleman, all the benefits of it disappear.
Yes.
Whatever those benefits are.
Gold is no one's liability. And I suppose what that demonstrates is actually perhaps it is crypto is somebody's liability. But no, I don't.
Well, there's the lesson then. If you're going to hold gold, hold real gold. Is that fair? Okay. Excellent. That's quite a nice place to end it. So I think we will end it there. I've taken up too much of your time. Thank you very much. But before you go, to ask you the question I keep forgetting to ask people, which is, have you got a book that you have read recently or are reading that you think that our listeners should read or would like to read?
Yeah. So last summer I reread Jim Collins's Good to Great. It's a fantastic book about how managements turn businesses around and have the right, effectively the right platform to get businesses turning them around, but actually then getting them to grow. And there are some wonderful examples of that. It was written in 2003, and yet the examples are as relevant today as they were then, frankly. So very readable. But in terms of having that up your sleeve to ask questions of management and see how businesses are evolving, that's a great book.
Brilliant. Sebastian, thanks so much.
Pleasure. Pleasure.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi and Moses Andam. Sound design by Blake Maples. A special thanks to Sebastian Lyon.